Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for WealthPress. Today is Monday. It's November 28th. We're almost in December, but boy, oh boy, oh boy, oh boy. We've got some good stuff ahead. Folks, I hope you all had a great Thanksgiving holiday. I hope you ate lots of turkey, maybe a little ham. T-Buzz and I were together. We had a great time. He was here for over 3 hours. He is so much fun at parties. Tom Busby, he's great. Shout out to him this morning. That's the first thing. Number two, as I warned all of you, we're opening up at about 184 points down. Now, this isn't significant, but I warned you last week and the week before that the U.S. stock market is getting ready for some downside. A lot of traders were believing that this rally right here, and I'm going to show this to you, and this is really important, folks. A lot of folks believed that this rally where the Dow went above the 200-day moving average, believed that this was finally a bullish rally. As I was explaining to everybody, this isn't a bullish rally. This is a flight to quality. Remember, bonds are going down too, so this is a flight to quality. Investors are trying to get out of their crappy stocks and into the best stocks possible, and trying to gauge or trying to be able to sustain the returns of the main indexes, which is the Dow Jones. But I'm telling you right now, it's not that easy, because look at the divergence. And we're above the 200-day moving average. But here's the really nasty part. So this is the 200-day moving average, and we're trading above it, and it looks like we're entering a bull phase. But when you look at momentum levels, let me show you this. On the Dow, you only have 57% of stocks trading above the 200-day moving average. That's huge vulnerability. And when you look at the composite on a momentum level, I want to show you guys this. You tell me if you think the stock market is ready to come out higher or not. Let me just show you this right here. Look at this. This is terrible. This is the Dow. Look at where we're at right now. Let me show you max. I'll show you 20 years. This is 20 years. In 20 years, or not 20 years, this goes back to 2000, it's about 15 years. 1, 2, 3, 4, 5, 6, 7, 8 times we've been above these levels. 8 times in 15 years, once every 2 years. So, folks, this is not a normal occurrence. This is a really overbought market, but only in the short term. Remember, this is the 50-day moving average. If you look at the 200-day moving average, which I'll show you right now, it's not looking anywhere near there. And that's telling we're only up here. And I don't think we're going to get up here because of the 50-day. So we are really overbought right now. And if you look at the S&P 500, this is the S&P 500. So look at this. Since 2007, we've been above these levels 1 time, 2 times, 3 times, and we're touching it right now. So I do not believe this is going to be a bullish week for the stock market. Maybe we'll fizzle out. Maybe we'll try to trick more buy stops into it. But folks, I'm telling you, as I'm sitting here right now, this is a market that's ready to cool off. Look at volatility. Volatility is looking like it's basing down at its level, and it's ready to go higher once again. So don't be surprised to see volatility move up to the $25, $30 level over the next few weeks. And the Dow Jones and the S&P, as I'll show you right now, this is the S&P. Look at where it is. This is the 200-day moving average right there, and we're right below it. Let me remove this right here so you could see exactly where we're at. I'm just going to make this easier for you guys to see. But as you can see here, we're right below the 200-day moving average, and it looks like we're already starting to cool off. I would not be surprised if over the next couple of weeks we went all the way to the 3,780 level, or if you're looking at the SPY, the 378 level, and then all the way to the 350 level to the downside. I think we're going to erase all of the gains that we've seen in the last month and a half. Yes, I've said it. Now, let's talk about threats and opportunities this week on our table. This week is going to be pretty empty. Tomorrow, you've got consumer confidence. That's a really big report in light of everything we're seeing right now. And on Wednesday, you've got GDP. And you've got retail inventories. But GDP is going to be the biggest report of the year. This is going to give us an idea of whether we're growing or not growing at the pace that the Fed is expecting based on our rates. Now, they're looking at a quarter-over-quarter growth of 2.7. But look at the consensus, 2.5 to 3.5. And it'll be really interesting to see how personal consumption expenditures, I'm hoping that personal consumption expenditures are rising and not falling. That would be really, really good to see. But I think this is going to be a big wake-up call. Also, we've got a lot of Feds talking this week, and we could be expecting a lot of volatility. Let's talk about global market and talk about what we can expect next. So markets participant shed away from risk, focusing on Black Friday sales and COVID-19 cases. Yeah, Friday was not a really great day. Friday's session, Apple lost about 2% over worries about reduced iPhone shipments in November and COVID-related worker unrest. And if Apple's going to go down, I think it's going to impact the market. Federal Reserve meets next month to decide the path. Next month is closer than you think, of interest rates for hiking its benchmark by 0.75 at each of its last 4 meetings. Now, notice the numbers continue to increase for the 7.5. Still not high, but remember they were like at 10%, 12%, 15%. Now they're 25.3%. And I think by the end of this week, they'll be like at 35% because, again, the Fed may not be backing away. And notice the 0.50 basis point is declining. That's exactly what I was talking about happening. I said after the last announcement, it was going to get hit really hard one way or the other, and it did, towards favoring 0.50. But now with all this negative data coming out, they're now moving the other way around. This week, we've got non-farm payroll for November. That'll be the main highlight, and investors hope that the Federal Reserve will slow the pace of increased rates soon. Yeah, they can be hoping. We've got also a lot of other data, consumer confidence, non-farm payroll, manufacturing, PMI, GDP, again, GDP, pending home sales, crude oil inventories, that'll be a doozy, core PCE price index, unemployment, so there's a lot. Plus, we have Mr. Jerome, I won't be honest with you till I get reappointed, wink, wink, Powell speaking at the Brookings Institute in Washington. A lot of Feds are going to be talking this week, so you should be seeing a lot of volatility. The Euro Stoxx 50 futures is down almost a point. Again, unrest in China. I just don't see how stocks could be rallying in light of what's happening in China right now. And today's in Europe will be the ECB President Christine Lagarde's speech at the European Parliament as investors look to the Wednesday's release of the preliminary Eurozone inflation data for November. There's a lot of data. China, oh boy, I need alcohol before I read this, and it's only 7:55 in the morning, and I don't drink. So when I say I need alcohol, the Shanghai Composite closed lower as protests in Chinese cities against the country's severe zero COVID restrictions boosted investors worried about the growth implications. Chinese civilians clashed with the police, frisky Chinese, including Beijing and Shanghai over the weekend. At the same time, the country logged 5th consecutive day of record daily COVID infections. Oh boy, here we go again. And it's winter now. 40,000 new cases on Monday, overshadowing any support to investor sentiment from the bank's 0.25 basis point cut to reserve requirement ratio announced on Friday. They're not getting any love. And the Nikkei went lower, and losses in rubber, electric machinery, and the steel sector. Folks, I'm going to tell you right now, this is not the week to be really, really strong bull. Last week, we had a really strong ratio of buys compared to sells. Look at the 20-day breakout. It went to 276, where the 20-day breakdown was at 13. I'm expecting this completely to reverse, and this number to start moving to the 200, 300, 400 level. Now, in terms of the best sectors right now, you're not going to get any news from me. You still got industrial, energy, material. Notice material and industrial starting to get friendly again. Notice utilities is starting to come up. It's not down in the crapper anymore. And consumer staples is not down there either. At the bottom, you have technology, real estate, consumer discretionary, and communications services. I would not be long any of these sectors right now, and I would be very, very cautious with industrial and basic materials, depending on what they do, and also financial. I like healthcare, I like consumer staples, and I love my energy. Now, here's something you need to pay very close attention to, and I want to show you this from a different chart so you could see it differently. This is, taking all the noise away, this is the S&P 500. Look at the trend line. You notice anything here? You notice something frisky going on here? I'm just pointing things out to you. Down, 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 and So please, folks, this is not a time to be a hero. This is time to be very, very defensive. And if you've been short, your patience may be getting ready to pay off. So be very, very, very careful. But I'm telling you right now, with momentum levels where they're at, the 50-day lines, with the 50-day line, the number of stocks trading above the 50-day line, we would literally need the war to be over, the GDP to be better, and the Fed to be like, we're done raising rates for this market to moving up. We're nowhere near there right now. So if you're expecting more upside, you are not being realistic, at least in the short term. I'm just being honest with you, and I'm going by what I'm seeing. We may be in for some downside. Now, the best part about all this is we have systems and strategies that do actually better sometimes in a down market than in a bear market, than in a bull market, which is great. And all last week, I told you about Celeste's new True Trend Pro strategy. It's very simple. It's very powerful. And the back testing dates back to 1927. I've never had any back test going back to 1927. And it shows you a real powerful requirement to get into trades Monday before the close when markets are down. Gee, let me think. Today's Monday. Markets look like they're down quite a bit. And today is the time for it. I mean, literally the time for it. Last week on Monday, this thing that I'm going to describe to you happened in the energy complex. We scored big on Halliburton. Now, so if you haven't locked in your membership yet, highly, highly urge you do so. Otherwise, you're going to miss out today's 3:30 alert. It only takes a few minutes to sign up. Click the link below, get all the details. And look, even if you don't join, don't you want to know the best indicators to filter trades for Mondays? What time of day Monday works? What's a great filter that happens between Friday and Monday to make it work? How long you should hold these trades? How well it does in a bear market? Whether you should trade below the 200-day moving average or above the 200-day moving average? Long trades. It answers all of these questions for you. And it also answers the burning question of, can you successfully swing trade to the long side when we're below the 200-day moving average? And what's the best day and time of the week to buy stocks? So even if you never sign up, you're going to learn this by watching this class. Check it out now. It's happening, and it's going to happen at 1 p.m. today. You don't want to miss out, and I want you guys to be there for the 3:30 time today so you could get a whole new signal. We got the watch list. It's going to be really, really cool. Follow the link below. Get in on this right now. Bye. Have a great day. Remember, comment, post email, send me emails, support@marketgeeks.com. Post comments below this video in the YouTube channel, in the Wealth Press YouTube channel, and I'll respond with an answer, and it'll benefit everybody. I hope that helps. Bye, guys. Take care and have a great, 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 great week ahead. And stay out of trouble. I'm going to be watching you.